Cash flows associated with capital budgeting. Remember, when we do capital budgeting analysis, whether it be an internal rate of return or a net present value or a payback analysis, what we are looking at are net cash flows to the company. We are not looking at net income. And one of the reasons for that is we are trying to measure the true benefit of the investment to the company. And sometimes, because of non-cash expenses which occur on an income statement, a net income number does not really give us the true picture of the benefit that flows to the company because we made the investment. The other thing to note here is that we only measure cash flow that happens because of the investment. So if you're talking about cash flows that were going to occur anyways, we do not use those in our calculations. We only look at cash flow that's incremental to the project. Sometimes items such as depreciation and taxes affect cash flow and really alter the picture. So that's why we want to look at what really happens to the company as a result of the investment. A very simple model that can be used to track cash flow or to measure cash flow to a company because of a project is to take the operating income before depreciation and tax, so earnings before depreciation and tax, off of the income statement, subtract depreciation, and there are different methods for depreciation, and that leaves us with our taxable income here, or earnings before tax. Pay the taxes, which is a cash flow related item because that takes cash, and that leaves us with our traditional earnings after tax or net income number, to which we will add back depreciation because that depreciation didn't go anywhere. That's cash that never got spent and it's still in the system. And what the resulting number is a number that we would feel more comfortable in using in a capital budgeting analysis because it shows us a truer picture of the cash that flowed from the project rather than just showing us the accrual net income from the project. Sometimes we have to make adjustments to the actual cost of the investment. And by that I mean if you were to say the investment costs $1 million, sometimes that number has to be looked at a little bit differently. One of the things that can occur sometimes is if we were replacing an existing piece of machinery, for example, you might sell the old machine. Well, that creates cash flow to the company. And so you need to net that against the actual cost of the machine and come up with something called a net cost. It's sometimes possible that by selling the old machine, you may create an additional tax benefit if you sell it at a loss compared to its book value. And so that tax benefit would also need to be included or netted against the net cost of the investment. So this is something that needs to be looked at very carefully whenever we're doing a replacement analysis to make sure that we're only counting the net cost of the investment when we do the IRR or the NPV or the payback analysis. One of the things we need to make sure of as we go forward, say in year 1 or year 2, is that we are only counting tax benefits and depreciation benefits that are incremental and new because of the investment. We cannot count tax benefits and depreciation effect that were occurring already maybe under the old machine. So if you're replacing a machine, you have to consider through all the years of cash flow that you're looking at, only what is different because of making the new investment. And that's the key when looking at cash flows related to capital budgeting.